The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. I'm Dave Clayman, CEO of 12 Points. We are going to be joined by Jack Manley from JP Morgan here as well. It is 12:01 by my clock. We're going to give everyone just about 2 minutes to get online. We had about 80 people signed up and we see about 15. So I want to give everyone just about 2 minutes and I promise we will get started in 2 minutes. Thanks everyone for your patience. All right, everyone, we're going to get started here in just a moment. As I mentioned, I'm Dave Clayman from 12 Points. I'm the CEO and co-founder. Many of you know me. We're very honored today to be joined by Jack Manley. Jack is Global Market Strategist for JP Morgan. He's been with JP Morgan for 10 years, and he is a member of their Asset Management Global Market Insight Strategy team. He must spend half of his time just trying to get that whole phrase out of his mouth. But Jack's a frequent guest on CNBC, Bloomberg, and other financial news outlets, and often quoted in the financial press. And we're very honored to have Jack here with us today. So, Jack, I'm going to bring up the slides and let you take it away.
Okay, well, thank you very much for the introduction. I know it's a bit of a word salad, so appreciate you making it through. Believe me, it's as awkward for me as it is for you. I'm desperately trying to get that bio changed, but the compliance has not allowed me to do it. So here we are, putting people like you in the unfortunate position of having to say all that stuff. But I'm glad that we are here right now. There is a whole lot to talk about. I greatly appreciate the opportunity, the time to be in front of all of you today. It's a great time to have this conversation, right? To kind of talk about the state of things from a macro perspective, from a markets perspective. There is a lot happening right now in the news, right? I was watching TV a couple of days ago, and all we could see was the collapse of FTX and the decline of cryptocurrency. And on Tuesday, we have a CPI print that surprises well to the downside. Yesterday, we have the Federal Reserve with its much looked at meeting, the last one of the year, and of course, so much more going on just from a market's perspective. Now, what I want to be very clear about with everybody on the line right now is that I do not have a crystal ball. Nobody has a crystal ball, so I don't feel that bad admitting that to you all, but I do.
We have to stop the webinar. If you don't have a crystal ball, everybody wants to leave.
I know that's what you were promised, right? Is absolute clarity on what's coming our way. But sadly, Dave, I'm ashamed to admit it. I don't have one. I lost mine actually. I used to have it. I can't find it anymore.
Yeah.
So the issue, right, is like I cannot precisely tell you what's coming down the pipeline. I cannot tell you with absolute certainty what the future is going to bring. But what we do try to do, and I think we do this pretty nicely, is we try to bring a little bit of clarity to the present. And given how much information is out there, how quickly that information is changing, that in and of itself, I think, is a pretty valuable proposition, right? Just being able to see the forest for the trees, isolate the signal from all the noise, focus in on the stuff that matters to us most as investors. And so we're going to cover a lot of ground in our time together. We're going to talk macro, we're going to talk markets, we're going to talk stocks and bonds, we're going to talk US, and even a little bit about international investing. And in doing so, hopefully we're going to address any of the questions that you folks on the line may have about how to think about current conditions. And to do that, we'll be going through a handful of slides from our flagship publication, something called the Guide to the Markets. Now, with that, let's turn to the first page of this presentation, please. You'll see it's page 21 from our Guide to the Markets. That page number going to be on the top right side of this page. I always think it is helpful to start by talking about the state of the U.S. economy. Because if you have a view on how the U.S. economy is doing, it's a lot easier to have a view on how the stock market may do, how the bond market may do. And from an economic perspective, I think one of the biggest questions that everybody's asking is the question around recession. Right? Have we been in a recession this year, or are we heading into a recession next year? And unfortunately, right, this is one of those questions that I just don't have an absolute answer to. It's really, really hard to be able to declare with authority what's going on with growth right now, because there is a lot of nuance, I'd say, to this story. There's a lot of gray area. This is not black or white. And what I mean by that is that there's some good news out there from a growth perspective, but there's also some bad news. Right, if we think about all the drags on the economy right now, well, first of all, we have 2 consecutive quarters of negative GDP growth to start the year off. That's never good, right? Typically coincides with a recession. We have a massive fiscal drag on this economy because the government is not spending as much as it did the last couple of years. Rates are higher, which is putting an impact on the consumer, where inflation is eroding away at our purchasing power. The housing market is slowing down because of what's gone on with mortgages. Trade deficit keeps widening out. All of these things are bad for growth. But on the other hand, right, there is some good stuff to say as well. I mean, you're looking at income levels, and they're higher than they were last year, or this time last year. You're looking at spending numbers, including this most recent holiday shopping season. That's higher than it was last year. Manufacturing activity is up relative to where it was last year. And hey, I mean, as evidenced even by the most recent employment report, this economy just keeps adding jobs. And none of that sounds particularly recessionary. Right, so hopefully you're all sympathetic to this idea that there is a lot of gray area out there. There is a lot of noise. It's hard to determine with absolute certainty if we're heading into a recession or not. It's not guaranteed. But I think really the question that ultimately matters for us as investors is by acknowledging that recession or not, this economy is clearly slowing down relative to where it was last year. We have to ask ourselves, how bad is this slowdown going to get? Right? How slow are things going to go? And if we do get a recession, how bad would the recession be? And that's why I like page 21 from the guide so much. It looks at the 4 most volatile components of the U.S. economy: housing investment and business investment up top, vehicle sales and inventory numbers on the bottom. Right? These are, chances are, the sectors that have contributed to past recessions. Look at what was going on with the housing market leading up to the financial crisis. Look at what was going on with the business investment leading up to dot-com bubble bursting, right? Very clear areas of excess, of overextension in this economy. These are booms that go bust. These are bubbles. And we all know bubbles burst. And when that happens, the pendulum swings in the other direction. You go from boom to bust, and you get a deep, dark, painful recession. Where we stand right now, things are, I think, very different, right? You can look at this page. Nothing is jumping off right now. No warning bells sounding. There are no sectors right now that are out of whack relative to history. Basically, everything's more or less in line with its long-term average. And it's hard to hurt yourself falling out of a basement window, right? So that's kind of how we feel from a macro perspective. I'm not saying the growth outlook is a good one. It's not. But when you compare the growth outlook to what confidence numbers are telling you, to what the equity market up until recently has been telling you, to what a lot of us, I think, feel or see or read in the news, the growth outlook isn't as bad as what a lot of us, I think, may fear. And now if we turn to the next page here, which would be page 30 from our Guide to the Markets, we can talk a bit about that other big macro force. That, of course, is going to be inflation. And a good time to have that conversation because, as I said earlier, just a couple of days ago, a new inflation print for the month of November coming in cooler, still at just north of 7%. Now, the question around inflation, I think, is have we hit peak inflation? Is the worst behind us? And kind of like with the growth story, right? This is a very nuanced conversation to have. It is not obvious, cut and dry. I mean, the trend right now is very encouraging. You can see on the left-hand side of page 30 that as of right now, June represents the high watermark for inflation, and every print since then has come in lower. That's good. We also have to acknowledge that there's not as much demand in this economy as there was a couple of years ago because the government's not mailing out free money anymore, right? Those stimulus checks aren't coming anymore. We also know that the cost of freight has come down. Things like maritime shipping significantly cheaper than they were a year ago. But again, on the other hand, there is still a war in Ukraine. And Russia and Ukraine, both very large producers of commodity products, food and fuel. We can see the outsized impact that's had on inflation on the left-hand side. And China continues to adopt this intense COVID policy, right? We know that things have eased up recently, but who knows how long that's going to last or how quickly that transition will happen. A lot of moving parts, a lot of opacity here. Very hard to claim with certainty that things may not get worse from here. They could. But instead of trying to tell you exactly what the December CPI print is going to look like, I'd rather focus in on a slightly longer term concept, which is this idea that there are some structural anchors that have emerged over the last 30 years that have helped to keep inflation in place. You know, globalization is a great example of one. That's deflationary. Online shopping and what it's done for our ability as price discoverers, that's deflationary. These things have not gone anywhere. They're just simmering on the back burner. And I think if we take that idea of there being these structural anchors and add on top of it this trend that is emerging, we can kind of point to a glide path for inflation, where maybe by this time next year, the inflationary environment is pretty different. Right, we are looking all of a sudden at inflation that's a lot more comfortable than where we are right now. But I would not expect us to get back to that 2% of yesteryear anytime soon. This is a new inflationary regime. Wage growth is running at multi-decade highs and will continue to do so because the labor force is smaller than it was 2 years ago. Home prices are elevated. Rent is elevated because there's not enough building activity. There is a chronic supply shortage of housing. That is not something that can get fixed very quickly. And so when we do see inflation settle into something more comfortable, again, it's not going to be that 2% figure that we got so used to seeing for the decade leading up to the pandemic. My guess is that it looks something closer to 3 or even 4%. Very different from where we are right now, but also very different from where we were just a couple of years back. Yeah. And that brings us now to the next page here to have a conversation about, yes, please.
I'll interrupt you for 1 second. We had a question, and I think it relates nicely to the first two slides. How about energy prices? Both, is that a fifth indicator on the cyclical page, and I'll add to the question, how do you think about it related to the inflation drivers and expectations?
Hey, that's an excellent question. And I would say it, historically speaking, has been an indicator. It could be something sort of cyclical. It's not a macroeconomic variable, which is why we don't discuss it on that first page. But you know, if you think about what happened as an example during the housing crisis, during the financial crisis, WTI was up at around $150 a barrel, and that was not good from a growth perspective. It's one of the reasons why we had such a painful recession. So falling energy prices is very important, and kind of how that feeds through into the inflation view is that, well, right now energy prices have stabilized and in fact have come down. I believe I read the other day that a gasoline is now cheaper today than it was a year ago, which is pretty remarkable when it comes to fueling up your car. And of course, there will be some regional differences in there, but at a national average, at least, gasoline is way cheaper than it was just about 6 months ago. But kind of alluding to that idea of there being a lot of moving parts, right? None of this stuff operates in a vacuum. A U.S. energy policy is not particularly friendly towards the fossil fuel industry. OPEC is not particularly keen on keeping prices low. The war in Ukraine has been highly disruptive of what's gone on with energy. And if China does indeed reopen, its energy demands are going to increase. All of those things could push fuel prices higher as we move into next year, especially when the winter months sort of transition into warmer months. We don't need to heat our homes as much, and energy demand on that front starts to pick up a little bit. So there's a lot to say on that, and I'm glad you brought up the question. It is one of the things that's helped recently in inflation prints, but I wouldn't count on it helping forever.
Great, awesome, thank you.
Of course, and that kind of brings us now to the next slide here, which will be page 34 from the guide. And we can have a conversation now about interest rates, right? Like, what is the Fed going to do about all of these things? Because it pays attention to growth and employment, and it pays attention to inflation. And this has been a very challenging year for anybody who is trying to figure out what the Fed is going to do, because I think a lot of people, including myself, would argue that the Fed is not managing policy particularly well. I don't really agree with anything the Fed is doing right now. I don't agree with what they're doing with quantitative tightening. I don't agree with what they're doing with short interest rates. I think the economy is slowing down naturally. I think inflation is largely outside of the control of interest rates. And so you kind of have to wonder why the Fed is embarking on its most aggressive rate hiking cycle that we've seen in decades. But I've also realized, and it took me probably a little bit too long to realize this, but I'm realizing as we enter next year, that the Fed does not care what I have to say. That Jay Powell does not call me and consult me for my views on monetary policy. Right. So even though I don't necessarily agree with what the Fed is doing, I have to wrap my head around the difference between what I think the Fed should be doing and what the Fed will be doing. And so yesterday was an important day, right? Because we got 50 basis point interest rate hike, the last one of the year, more or less as expected. That sent the overnight federal funds rate to just south of 4.5%. We also saw, though, a much more significant upward revision to what's going on with terminal rates at some point next year. The Fed is now projecting at least 2 more rate hikes next year. We could see even more than that. Now, the issue here, right, is that the Fed, at least on paper, is data dependent. It's paying attention to what's going on with growth. It's paying attention to what's going on with employment with inflation. And we have to recognize that something could change, could happen over the next couple of days, or a couple of months, I should say, that would change the Fed's view on rates. So while we do have this idea right now of where interest rates are going, just like with inflation, just like with growth, nothing is set in stone. So rather than trying to tell everybody exactly where the Fed is going to land and when it's going to get there, and by the way, my opinion on that is probably around 5% by the end of the first quarter of next year, but that is just my opinion. I'd rather say that from here through the end of the first quarter of next year, the Fed will continue to raise interest rates. Don't know by how much, but I know they're going to do it. But that we are much, much closer to the end of this hiking cycle than we are to the beginning. And that, I think, has some pretty important implications from an investment perspective. So let's turn now to the next page here and talk about how we make sense of this as investors. This will be page 37 from our guide. I want to start by talking about the bond market. And bonds, I think a lot of us feel, burned us this year. Bonds betrayed us. You're not supposed to lose that much money, 14, 15, 16% in high quality U.S. fixed income instruments. That's just not supposed to happen that way. And I think the problem, right, is that we have conditioned ourselves to view fixed income as protecting us against equity market volatility. Stocks go down, bonds go up, our portfolio stays afloat. But maybe a better way to think about this is that bonds protect us against economic volatility, in the sense that if there is a recession and the Fed cuts interest rates fall, yields fall, prices of your fixed income instruments rise. That's just kind of bonds 101, and you make money in fixed income. But that is not the environment that we were in this year. Right? We were not in a recession where the Fed is cutting interest rates to stimulate growth. It was the exact opposite. Red hot economy, overheating, super high inflation, the Fed slamming on the brakes, raising rates. And when rates are rising, prices fall and you lose money in fixed income. Now, I am not saying that what happened this year has been pleasant. It has not been. Or that it's normal. It is not. Or that anybody could have really accurately predicted just how swift and painful Fed action would be. Nobody really did. But what I am saying is that given that macroeconomic backdrop, hot inflation, overheating economy, rising interest rates, fixed income did sort of what it was supposed to do. And I bring that up because it makes the point, I think, that bonds are not broken. I am very constructive on fixed income right now for the first time in about 10 years. The yield that you get out of fixed income instruments is extraordinarily impressive. You could buy short duration, high quality U.S. treasuries right now and lock in a 4.5% coupon, a number that you have not been able to see for a very long time. And that high coupon provides ballast. It provides a little bit of cushion against interest rate volatility. Now, again, I don't know exactly where the Fed is going to land or when it's going to get there, but I can say for the first time in a long time, there is more upside potential than downside risk in fixed income. And I think the right-hand side of page 37 illustrates that quite well. It looks at what happens if rates rise or fall and what that does to the total return of all of these different fixed income asset classes. The blue bars are what happens if rates fall, gray if rates rise, and hey, the blue bars are bigger, right? There's that visualization of this idea that there is more upside potential than downside risk. Yeah, there may be a little bit more pain to feel over the next few months, but it'll be nothing compared to what we've experienced over the last 12 months. And trying to time exactly when the change happens will be basically impossible. So if I'm approaching fixed income right now, I'm either going very short duration and high quality for income, or I'm going a little bit longer duration and high quality for protection. But in both cases, bonds work. Now, this brings us to the next page here to talk a bit about the equity market. Similarly, a nuanced story, right? There is some good, there is also some bad from this perspective. The good news is that stocks aren't expensive anymore. Right at the start of 2022, valuations were north of 22 times forward earnings. You can see on the right-hand side of page 5, this is the most expensive the stock market had been since the dot-com bubble. And a lot of people looked at those numbers and they said, this is not sustainable. Things have to go lower from here. And they were right. The Fed steps in to fight hot inflation. It raises interest rates. It crushes the equity market. But if you are a glass half full kind of guy like I am, you look at that and you say, well, at least the silver lining here is that valuations aren't rich anymore. The stock market isn't expensive anymore. And in fact, right now, the equity market is trading more or less in line with its long-term average. So again, the good news here is that valuations aren't a problem. But if we look at the next page here, page 8 from the guide, we can see that there is bad news too. And the bad news is the earnings story. 2021 was an extraordinary year for corporate profitability. We can see on the right-hand side of this page, 70% year-over-year earnings per share growth. The best year in decades, but so much of it driven by margins, by companies getting really lean, really profitable in the aftermath of COVID. And we know absolutely that this is not sustainable. Wages are up, rates are up, input costs are higher, margins have compressed, and they are compressing at a time when this economy is slowing down to its from its fastest pace of growth in decades to maybe a recession, right? So it's going to be hard to find earnings this year. It will continue to be hard to find earnings next year. And with this as our backdrop, how do we approach investing? Let's look at the next page here, page 10 from our guide to the markets. Helps to answer that question. Now, I said earlier, right, stocks aren't expensive, and that is good news, but some of us on the line are still going to be bargain hunters. And if you're looking for a good deal in the equity market right now, the left-hand side will show you that value stocks are trading at a 40% discount relative to growth, as cheap as they've been in 20 years. Now, let's say you're looking for income outside of the bond market. Look to the table on the left-hand side, and you'll see that the dividend yield of value stocks is more than double what you get out of growth equity. And if you're trying to figure out how to find a company that'll make money in today's environment, let's look at the right-hand side. Operating leverage by sector, and all operating leverage is the impact of a 1% rise in revenues on your bottom line. How much juice can you squeeze out of this economy? And the top 3 sectors, they leap off the page, right? Energy, financials, and materials, value-oriented. You want to put this very simply, there is value to be found in value. But I am not telling us that we're on the cusp of some sort of shift where value is going to outperform growth for the next 10 years. I don't believe that story. This is short term, it's tactical, it's opportunistic, it takes advantage of current conditions, and we have to match this with a longer term play. And to me, that long term play is growth. It is technology and tech adjacent names. And yes, growth at any price investing is dead for as long as interest rates are above zero. But growth at a reasonable price investing, I think that is still very much in play as a viable investment philosophy. And so the name of the game as equity investors right now, I think, is balance between the long term and the short term, the growth and the value. But it also means thinking about the equity market a little bit more holistically. So let's look at the next page here, page 16 from our guide to the markets, perhaps my favorite page in the guide. The S&P 500 peaked this year at 47.97 in January. And I can tell you, I'll open up my phone right now. The S&P is off 2.5% right now. We're at 38.95, so we're about 900 points off the high. It's pretty far ways to go, right? Now, what we have to ask ourselves as investors is, are we ever going to get back to where we were in January? And I'll tell you why that may be a binary question, right? Yes or no. There is only one right answer, and the right answer is, of course, yes. Of course, we will get back to where we were in January. The real question we have to ask ourselves is, how long is it going to take? And so what we do on the left-hand side of this page is model out what happens if you put $1 into the stock market and ride it from here to recovery. If you think it's going to take a year to get back to where we were in January, you're locking in about 20% over that time period. You think it's going to take 3 years to get back to where we were in January, you're looking at about 8% or so, given the most recent numbers, per year over the next 3 years. 5 years, you're looking at about 6% per year for the next 5 years. These are good numbers. I can sleep easy at night putting money into the market today. I don't have to care about what the Fed's next move is, or what the next inflation print is, or what the next unemployment rate is. All I have to know is that a dollar that I put into the market today will work extra hard for me over the next 1 year, maybe 2 years, maybe 3 years, maybe 5 years, but it's going to work extra hard. And just as within the fixed income market, I can say pretty confidently that for stocks, there is more upside potential than downside risk. That holistic view on equity investing. And speaking of holistic investing, let's turn to the next page here and zoom out even further. We have to talk a bit about international. And I'll be the first to admit on the line, I am not an international bull. I have never been an international bull. The arguments there in favor of international overweights just don't excite me. Yeah, international's been cheap. It's been cheap for a while. Maybe it's cheap for a reason. But I do have to acknowledge that international assets, at least from a shorter term perspective, have some potential. Right, places like Europe, Japan, Canada, the UK, they're very cyclical in nature, much more exposure to things like financials, industrials, materials, and energy than the US is. And at the start of this year, that stuff started to sound very attractive because the whole world was recovering from COVID. We were in the early innings of a global cyclical upswing. But that lasted, what, maybe 6 weeks? Russia invades Ukraine, turns the outlook on its head. All of a sudden, that short-term allocation doesn't make a whole lot of sense. And if you look at page 51 from our guide, which tracks economic activity at a global level, anything above 50 indicates expansion, below 50 is contraction, green is good, red is bad, and things aren't looking so hot around most of the world. Global PMIs are lower, manufacturing and services are both contracting, the developed world and the emerging world both contracting. This cyclical growth story is done. But we do need to match that up with the longer term play. And the longer term play, I think, is the emerging world. It is EM Asia in particular, heavy exposure to manufacturing, to the consumer, a large and rapidly growing class. And critically, it's not just China anymore. It's other parts of Asia like Korea, Taiwan, Vietnam, Indonesia, India, high growth areas that deserve a place in your portfolio. And that brings me now to the last page, page 62 from our Guide to the Markets, just to say, I spent about 25 minutes or so going over my high-level views for what may happen with growth and inflation, what may happen with the Fed and interest rates, and where the risks and opportunities may lie in both global stock and bond markets. But as I said right at the beginning, ultimately, I don't know. I don't have that crystal ball. If you look at page 62, you can see that it is impossible to predict what the best or worst performing asset class is going to be in any given year, because it is impossible to predict what that next big source of volatility is going to be. A year ago, no one is pricing in a war in Ukraine. 3 years ago, no one's pricing in a global pandemic. Stuff happens very quickly and turns the outlook on its head. So rather than trying to predict that next big source of volatility, what you have to do is prepare for it. And the way you do that is through diversification. Owning all these things that we just talked about across styles and sizes and sectors and asset classes and geographies, putting together a nice little asset allocation portfolio. And you will see on this page that asset allocation, it's not that cool. Right? You will never be the best performer. You are never going to knock the cover off the ball. You will never be at the top of this chart as an asset allocator. But I think ultimately that is okay. Because most of us on the line, we are not short-term traders. We're not day traders. We're not chasing performance. We are long-term investors looking for long-term investing success. And if that is the mindset, then we have to remember that the journey is going to be just as important as the destination. So again, I want to thank you all very much for the time. Dave, thanks for the opportunity to be here, the invitation. It's greatly appreciated. I hope this was helpful. And I do certainly have some time for questions from the group if there are any. But Dave, back over to you.
Absolutely. Thank you, Jack. Yes, we have a question. What is your outlook for the dollar?
Oh, man, that's a good one. So unfortunately, trying to predict short-term dollar moves is basically impossible because there's a lot going on here. I will say that over the long run, the dollar is overvalued and needs to come down. And the easiest way to measure a view on the dollar is to look at what's going on with the U.S. trade deficit. We buy a lot more from overseas than we import from overseas. So exports are bigger than imports. Every time imports are bigger than exports. Every time we import a good from a foreign market, we flood the global marketplace with U.S. dollars, and the supply of dollars should be matched with a fall in price, right? So it should be a dollar negative. Unfortunately, over the short term, other things are much more important. Sentiment is a big indicator, and right now the world kind of feels like it's falling apart. Whenever that happens, it's dollar positive because U.S. Treasuries are the highest quality asset you can possibly park your money in. We also know it has to do with interest rate differentials. And the U.S. Federal Reserve has been hiking and hiking and hiking. And while other central banks around the world are trying to do that, they cannot keep up. And as long as there is a meaningful difference between U.S. rates and rates around the rest of the world, there will be continued sustained upward pressure on bonds, which in turn translates into sustained upward pressure on the dollar. So if I had to sum this all up, I would say I don't think we're going to see the dollar move materially higher in 2023, but I also don't think we're going to see it move materially lower. I think it's going to transition from being a headwind to a neutral factor as opposed to an outright tailwind for certain parts of the investing landscape.
Awesome. You didn't just say, well, it was on the cover of all the magazines a month ago, so clearly it's about to fall. Cover indicator.
That's another way to think about it. Yeah.
Two more questions I see right now. Given where we are now, is it good to take equity dividends or reinvest in securities? If you're comfortable taking it, or I can take it, whichever you'd prefer, Jack.
I'll say very briefly, Dave. I mean, I think it has a whole lot to do with where you are in life. If you're a younger investor, I would always advocate taking those dividends and reinvesting them, especially if you have another source of income. If you're a little bit older and you don't necessarily have an alternative source of income, clipping the dividend can work, especially because compound interest just doesn't work as much in your favor over a shorter time period. But that's really all I'd say. I think you probably have more to add on that.
Yeah, and just to Jack's point, based on where valuations are now, while stocks aren't expensive, they're not yet cheap. They are cheaper, and reinvesting your dividends can be helpful in this scenario where markets have fallen. We had stopped reinvesting dividends there over the last couple of years, but we are now starting to reinvest dividends based on more attractive valuations. And then, is investing in gold a good strategy for now? Is that one you want to touch, Jack, or?
Gold has historically speaking been a pretty decent hedge against inflation, especially since the dollar or the U.S. went off the gold standard in the early 1970s. The nice thing about gold is that it also has practical applications, right, from a scientific perspective, from a jewelry making perspective, right? People like gold; it's shiny. We can't ignore that. So there is like sort of a use case for gold. I would also say that with the crypto bubble kind of deflating, a lot of the money that would have gone into crypto is probably now going to head back into gold, and that could, in theory, be beneficial. But for those people that are interested in gold, I won't say no, but I would not advocate any more than a small percentage of your overall portfolio balance being dedicated to gold. And if you were to buy gold, I would buy the physical asset as opposed to say the miners or something like that.
Well, those who have spoken to me ever before know that gold coming into this year was my favorite asset class, which was a frustrating year for quite a while. Thankfully, it's the crypto bubble is helping some of that to come back here in the back end of the year. But I think again, small percentages. Our percentages typically are about 2.5% to the metals, and we'll slightly disagree. I think the miners are extremely cheap based on where the current valuations are versus the price of the metal. So we are about 2.5% to the metal and 2.5% to the miner, but that's a heavy position. So I wouldn't go any larger than that. All right. Yeah. That looks like we have all the questions. Jack, I will thank you very much for your time. It was very informative. We appreciate it. Our views are very well aligned, as you know from our discussion. Thank you very much all for joining us, and we look forward to speaking to you. We wish you all a happy holiday, and we look forward to speaking to you in 23 when we'll have a whole new slate of webinars for you.
Thanks all very much. Bye-bye.
Take care. Bye-bye.